Global supply chains across the world are currently plowing through a massive, unprecedented storm of economic disruption and dangerous regional conflict. Yet in the middle of this turbulence, Star Bulk Carriers generated $58.5 million in profit for the first quarter of 2026 and is now targeting a total return of more than $3 per share for the year. This table shows their unaudited financial results. Look right here at the net income line for the first quarter of 2026. That translates to $58.5 million in profit. Dry bulk shipping companies like Star Bulk operate under a very specific business model. They act as pass-through vehicles, converting physical freight rates directly into cash for their shareholders. When global demand spikes and vessel capacity tightens, freight rates surge. In those conditions, Star Bulk functions as an unrestrained cash generator, capturing the premium and passing it straight to investors. The trade-off is total exposure on the downside. If global trade slows or commodity demand drops, those freight rates can collapse, pulling the company's cash flow down with them. That creates the central dilemma for evaluating the stock. You are weighing an optimized corporate machine against external risks like regional wars and economic stagnation that management cannot control. To decide if Star Bulk belongs in your portfolio, you have to balance the bullish reality of their internal financial data against the bearish reality of the macroeconomic environment. Star Bulk operates under a strict full payout dividend policy. After they cover their capital expenditures and service their debt, they distribute their entire remaining operating cash flow directly to shareholders. This chart shows the immediate impact of that strategy. Down here in the dividend row, you can see they declared a payout of 50 cents per share just for the first quarter. Distributing all of that cash carries a trade-off. It means the company retains very little capital buffer to acquire new, cheaper vessels if market prices drop. It also amplifies their volatility because almost all of their 141 vessels are chartered in the spot market rather than being locked into fixed, long-term contracts. This chart illustrates how Star Bulk's dividend payouts map directly against the severe fluctuations of daily freight rates. When shipping rates spike, the dividends follow, and when rates fall, the payouts shrink proportionally. This structure ensures you capture every dollar of upside when trade is booming, but it provides zero revenue protection if the demand to transport dry bulk commodities halts. Investors should treat Star Bulk as a high-sensitivity instrument for playing spot market momentum rather than a defensive utility for stable income. Those spreadsheets depend entirely on physical ships successfully navigating some of the world's tightest and most contested choke points. The bull case for Star Bulk rests on their internal operations, where they leverage a 141-vessel fleet while maintaining operating costs that are among the lowest in the industry. This data table shows exactly how lean. Look at the bottom rows. Their daily operating expense per vessel is $5,071, and their daily net cash G&A is just $1,375. The bear case is entirely external. Ongoing conflicts in the Middle East and the Red Sea are degrading the predictability of commercial shipping, forcing vessels to operate near active military zones. We saw this physical risk materialize on March 11, 2026. The Star Gwynneth, one of their Kamsarmax vessels, was struck by a projectile near the Strait of Hormuz. While that specific ship suffered minimal damage, the broader financial impact of these risks is significant. Rerouting fleets away from the Suez Canal and Hormuz results in longer transit times and delayed deliveries and inflated insurance premiums. You can have the most efficient cost structure in the shipping sector, but a single regional conflict outside of management's control can completely disrupt your operations. Management has aggressively reduced their debt load to prepare for these disruptions. In April 2026, they prepaid the entire $48.8 million outstanding on one of their major credit facilities. That capital allocation leaves them in a formidable position. They hold 29 completely debt-free vessels and maintain over $540 million in pro forma liquidity. They need that liquidity because the entire industry is facing a wave of mandatory regulatory spending. New environmental mandates from the IMO and the European Union are forcing operators to reduce emissions. This forces companies into an expensive fleet renewal cycle. Star Bulk has to scrap older tonnage and fund the construction of highly specified, fuel-efficient new builds, like the Kamsarmax vessels currently joining their fleet. These environmental upgrades and new vessel purchases act as a direct tax on shareholder returns. Every dollar required to meet emission standards is cash that cannot be distributed as a dividend. Star Bulk's fortress balance sheet functions as a necessary defense against a decade of mandatory, expensive regulatory overhauls. Star Bulk presents a clear tension. The data indicates they are one of the most efficient operators in the dry bulk sector, but they generate their revenue by sailing through the world's most volatile waters. This chart maps how this stock aligns with different investor profiles. The vertical axis shows tolerance for volatility. The horizontal axis shows need for immediate income. If you are a passive investor looking for stable retirement income, this stock is a mismatch. If you buy for current yield, shipping's cyclical nature guarantees dividend cuts during downturns, triggering panic selling. The ideal investor is an active macro trader. You'd use Star Bulk as a targeted vehicle to bet on supply chain tightness and rising commodity demand. That strategy involves harvesting their cash payouts during the good quarters, while positioning yourself for the underlying fleet assets to appreciate during a bull market. Executing this requires actively monitoring global trade data, forward freight curves, and geopolitical conflicts to know when the cycle turns. Star Bulk is built to survive and pay out in volatile markets, but you must actively navigate the surrounding storm.